And this is from Jason. All right. And Jason said, is referring to the married put strategy, our preferred structure under radioactive trading, where I'm going to buy stock and I'm going to buy a put that's 150, 200, 210 days out above the current stock price to keep my risk to single digits. You've all heard me talk about this, of course, ad nauseum perhaps, but that's 50% of my total portfolio. Now, of course, naturally enter the married put. It's got a bullish skew. I've got a positive delta because the stock has a 1 delta. My put only has a 0.5, 0.56, 0.57 delta. So if the stock moves up as I'm expecting, I'm making money on the position. But then I can use income methods. Options give us options. Income method number 1, the simplest of all, I'm protected out to 210, 240 days. Why don't I just sell a call right away? Or if the married put doesn't go in the direction I want, it starts to fall. Why do you guys never talk about selling calls below the put strike price when you have a married put on the stock that's falling? I could sell an at-the-money option on the stock and buy it back the day it expires. It may cost me more to buy back, but I would receive the intrinsic value in the shares I am holding. That's sort of the catch, isn't it? I see this as giving me some income when the stock is flat to down, especially when my put is way above the strike price. So why do you all not recommend selling options below the put strike price? Selling calls he's referring to, below the put strike price when we have a married put position. Now, I want to use power options to discuss this. I was going to put slides together for this, and I might do it later for Fusion subscribers. We've had multiple discussions on this. In fact, we had a full 3-part mini-series on this back in June 2024 that I included in my email reply to Jason regarding selling calls below the put strike price. And I'm going to walk you through how I answered Jason. I like doing this from time to time. It gives you guys an idea of what's going on in my mind when you send in an email or you ask a question via the webinar, how my mind works, so that maybe it can help you say, hey, Mike talked about this, but I know how he's going to kind of answer this, but I want him to answer this a little bit differently. But hey, I'll answer anything, any guys you give me anytime. All right, let's go to our married put portfolio. This is what I did. Jason's asking me, why would I not sell a call below the put strike price on a stock that is down, or when I open a position immediately, I could sell the at the money put, and if the stock moves up, hey, it's okay because I gained the intrinsic value back on the stock itself. And what I discussed with him, sent him some screenshots, but discussed why I'm not selling a call right away. I used my Caesar entertainment position. This was opened about 2 months ago, 2.5 months ago, 74 days ago. We bought Caesars at 28.03. We bought the January 31 put for 550. Now, this initially, the stock is down 6%. Earlier today, when I sent him the screenshots, it was down to 7%. It was, we'll see that in just a moment. But right now, I'm at a 2.4% loss on the position. Again, if I hold it all the way to expiration and make no adjustments, I'll lose 6%. The original maximum risk was 7.5%. But we've used income methods so far. We've lowered the risk by about 50 cents on the trade, 56 cents, 57 cents. So my cost per share on the stock is $27.47. We only have a risk of 6%. Important fact, stock's at $26.34, down 6%. I'm holding the 31 put. Why am I not selling calls at the 25, 26, 27 strike now that the stock has reached these levels? And what I showed Jason in the email was, number one, the reason why we don't do it is because it increases the risk to the upside beyond the approach we're using. We're trying to control risks to single digits, to the downside. And yes, if I sold a call right now, maybe I could sell the 27 call for 45 cents, 50 cents if I was a month out, maybe 10 cents or 15 cents for 2 weeks out. That's 10 or 15 cents or 20 to 50 to 70 cents I didn't have today. It's absolutely right. It would lower my risk to the downside. This would lower. But you have to focus on the cost basis of the overall position. Even with the initial income methods I used, and I lowered my risk from 7.5% down to 6%, 133 days from now, that's the worst case scenario. The fact is, if I sell a 27 strike call, I still have a cost basis of $32.97. That's going to increase my risk to 597 to the upside if Caesars has a sudden pop up beyond that strike and it goes in the money. What's happening? I've lost the positive delta on the stock position. It's no longer there. It's countered by the delta of the call, which is going to -1. And at the same time, my put is losing value. The focus is on the cost basis, not the current stock price. It's almost the same thing as I'm in a covered call. My stock fell 20%. Oh, I just keep selling calls at the lower strike until it comes back to break even. Well, now you're running the risk of getting assigned for a loss if the stock suddenly moves above it. We go 14 days out in time. It moved up to 26.34. I sell a 27 strike call, let's say, for 68 cents. Remember, I'm still holding the 31 put. In this case, my cost base is still 32.97. I'm selling a 27 call, 6 points essentially below my put, below my cost basis, not below my put strike price. Let's go ahead and run that. Now this one is barely at break even. In this tight window of 26.95 to 27.03, I'm at a break even, much better than the 2.4% loss I'm at right now. Right? When we looked at the portfolio, the monetary loss if liquidated was 2.4%. Oh, sorry, folks, it was 2.4%, $78, 78 cents. Okay? So right here, I could essentially break even. But if the stock moves up to 27.50 at expiration, pretty much at a $57 loss. And if it moves up here, a loss of 72. Now I've lowered the risk down here. My downside risk is lowered. What happened to my upside risk? It went up to 16.4%. 3 times, almost 3 times the 6% I lost that I had in the upside direction. Now, what I also said to, answered to Jason, is that, okay, this is the risk. If you feel that you can time the market correctly, you feel we're in a neutral market. We've already seen David say that, hey, I don't think we're in a sideways market right now, but I might want to skew my iron condor one direction or the other. I'm going to have a follow-up on that, David, next week. It's going to be a post-recorder presentation. You saw it. I think you guys saw it. I don't want to break this conversation. Well, David, I'll email you about that, and you guys will see another presentation on it. There was an interesting fact with that iron condor that I think you guys picked up on that was very telling. A lot of times it's very telling. But in any case, let's look at the chart. So essentially, here's our 3-month chart for, there's the skew there. When I go back, we opened it essentially on the date was 23rd of June. Yes, I was right. I apologize for switching, folks. So June 23rd-ish. Let's skew this chart here. There we go. Oh, I want to change this to OLC for now. It's a little just easier to see. Opened the married put here. This is what I illustrated. We opened it around this time, June 23rd. As I mentioned, in that, kind of $28, $27 range, 28.03, I think it was. The stock did exactly as I expected for a married put. This was taken directly from the search. What does that mean? When I open a married put, I'm expecting the first 20 to 40 days, we're going to move up 3 to 5%. We did exactly that. All right, we moved up from about 28.03 into the 29 and into the 30 range. First income method was used here. That call expired worthless here. And then we had this steep decline. Now, I've got to admit, Jason's got a point. The stock's trading here. I could have, we're holding, remember, the 31 put. We did do a 31 call that expired where the stock breached here, matched exactly what I wanted in the first 20 to 40 days in the position. Then it wavered. I was thinking about selling another 31 call. Probably should have, but didn't see this coming. Now, could I have sold, let's say, the 29 and then bought it back cheaply and then maybe sold a 28 and then bought it back cheaply and then maybe got a 26 and bought it back cheaply? And that was all money I would have had. Remember, I'm holding the 31 put and I'm selling these calls here. Yeah, that could have worked out. So at this point, we're at 24 something. We're at 24, I think it was 24.30 on March 11th. Oh, I'm sorry, August 11th, folks. I'm sorry, August 11th. And that's what I showed Jason. So I'm down here. The stock's at 24.30. I've got the 31 put. Why wouldn't I sell the 25 call at this point? Which was about 62 cents, if I'm not mistaken. For 1 month out, 25 days out. Well, what am I seeing here, folks? I'm seeing a MACD bottom, which is my warning sign to use, not a warning sign, but it's usually my trigger to use income method 9 to take the profit off of this second working asset, the 31 put, and lower it to this range, and then sell the call. Income method number 9 and income method number 1. It's in the combining income methods chapter of the blueprint. But had I done that, and we showed this to him as the illustration, remember, had I been holding the 31 put and the stock's down here, why wouldn't I sell a 25 call here? Well, I'm seeing these technicals, and I get a confirmed technical here of the stock moving back up. Selling a 25 call here for 62 cents would have put the risk into the 20% range to the upside on signals that's telling me it's moving up. So I showed him the example. If I had sold the September 5th option, today's expiration, on our Caesar position on August 11th, so it was 25 days out. This is the 25 day out. The 25 call, we would have sold it for 62 cents, as I mentioned. I have no chance for profit on the trade. Risk goes up to 24%, $790. 4 times the 6% risk I have. Now, did I lower the risk to the downside? Yes. I got an extra 62 cents. So if the stock continued to fall and stayed below 25, I'd have a lower risk to the downside than the maximum risk I had. Why do we not sell a call below the put strike price when the stock falls? Because you drastically increase your risk to the upside if you're in a volatile market, or if you're in a market where your stock's been depressed and could suddenly spring up. It's the same thing as, why don't you just roll down the covered call when you've got a 10, 15, 20% loss on the position? You hedged it by 2% on the initial covered call. You got a 20% loss. You're only down 18. Why not sell the call there? Well, because if the stock gaps back up 4, 5, or 6%, you're getting locked into that loss at the call strike price. And Jason mentioned as well, why do I care if I've sold this call here at our 25 strike price? If the stock's trading at 27 and it costs me $2 to buy it back, I don't care, because I've made that back from where I was on the stock. I've got that intrinsic value back. But what do I have to do now, folks? I got to pay the $2 to buy that back, which is going to do what? It's going to increase that risk. We had a 7.5% risk on the initial married put. We did one income method because the stock did what we wanted, as it does 68 to 60 to 70% of the time of the trades that we pull from the married put default search do exactly that. They move up 3 to 5% in the first 20 to 40 days. So we started with 7.5. We had lowered it to a 6% risk with that one income method. Now we do this, and that lowers my monetary risk. Oh, I'm sorry. My numbers are wrong. I am so sorry, folks. I entered that completely wrong. It wasn't 0.62, it was 62. It's much better. It wasn't 24. Sorry, folks. In any case, you get the idea. It's the same picture. It's the same picture. Yeah, it was 22 points. It was 22.9, I think, in my email, 735. Still almost close to 4%, or 4 times the 6% risk we have. So started with 7.5, lowered it to 6, lowered the risk again by 62 cents to the downside, yes, but to the upside, I've increased my risk to 23, 24% if there's a change. Now it's moved up. When the stock was trading at 24.30, 24.50, and I sold the 25 call, now that we're at 26.34, I gained the 2.34 in the stock from where it was. But I have to pay back some of this premium, $1.08, $1.09. And when I looked at it today with Jason, I apologize, it was $1.09. And so let's go back in here. We're on this 5th of September. Today's expiration, my apologies. It's a little bit higher now, but we're going to keep that. We're going to use that 119 price to buy it back. Let's keep it clear, folks. I'm sorry. Let's use 119. Here we go. Now my risk is 7.6% on the position. I wanted to sell. Step back. We use the income methods to reduce the initial at risk, potentially bulletproof the trades, and increase our profit. The stock fell. It went opposite. The married put is a bullish position. I could have bought an income method number 12 when I saw the negative MACD cross, and this position would be at a 12% profit. I've been hesitant to do that recently because of the price of the puts. But here we are. What did we do? The initial married put position had a risk of 7.5%. Did an income method because the stock performed as expected, as it does 68-70% of the time when I pull it from the default married put search on power options following the rules in the blueprint. We reduced it to 6%. The stock fell. I'm at a loss now of minus 2.4%. And hey, I got to panic sell. I got to keep reducing this risk. Why wouldn't I just sell a 25 or 26 strike call right now? When the stock, August 11th, when the stock's at 24.30, because it doesn't matter. So we took in 62 cents, but that increased the risk to 24% to the upside when we saw MACD crossover and other signals that were leading to a bullish nature. We buy it back for 119, 120, and where am I at right now? Because I sold a call below the put strike price following the position down. We're right back where we started. In fact, we're 0.1% higher, right back to where we started 70 days ago. And of course, when and how to use this, why we don't sell the calls below. As I mentioned in that chart, hey, if I would have followed CZR down, in this case, could I had maybe another 50, 60, 70 cents here to reduce my risk? And then if I still sold a call here, have to buy it back, would this have countered this? Possibly. But there was always the risk. What was right in the middle? Why didn't I sell a call when the stock started to fall here? Why am I going to sell a call to cap the upside with a locked-in loss that we saw below the break even when I have earnings coming up? Obviously, the earnings didn't do too well. The market didn't take to these earnings well. But if they took it well, then we'd be going this way. And this would have been a disaster. That's why I didn't sell a call when it was falling. Why didn't I sell a call here as it was continuing to fall? Because I was looking for this, then I started to see it. That's not when I sell a call. This is when I want to use income method number 9 in the blueprint. Taking advantage of the second working asset, the put option, was probably at its highest profit, highest value that it was during this time frame, reduce my total cost basis, lower the put strike price, and then do income methods in this range that are above the put strike price. That's the proper play, Jason. Not chasing it down with the calls and risking getting assigned at a loss, risking a profit and loss chart that, just is no guarantee for a profit. Okay, so the best case scenario is I'm at a loss that's less than I am right now. I'm at a loss of 60 instead of 78 that I am right now. You mentioned the intrinsic value of the shares you're holding increases, so why is it a problem? Because it's negated. At this point today, any range that this stock is above that sold call, now that it's in the money, this call went to a delta of -1. I am not seeing the intrinsic gain here on the stock because I'm paying it back to close this call. Yeah, I took in 62 cents, but now I got to buy it back. As actually, when we saw that example, when we saw the buyback, we put it in at 119. Well, it's a 25 strike. As we got closer to expiration, the stock's at 26.34. We're going to be buying this back for 135, 140. It's at least going to be intrinsic value, maybe 5 cents more. Market maker's probably going to charge us 140. Stock at 26.34. Even in the last 10 minutes, 15 minutes to expiration, 25 call, I'm paying 140 for that. Obviously, I might even pay 145. Oh, how did I do that wrong? Oh, no, I did. So now my risk goes to 8.1%. I had taken it from 7.5 down to 6. Now I've increased it by 0.5, 0.6% from where I initially started. That's the wrong direction. My cost basis is increasing. Did the stock move up from when I sold the call from 24.30 to 26.34? Yes. But I negated that because this delta went negative. I took in 62, paid back 140. I added 82 cents to my cost basis. I'm sorry. Sorry, folks, I read that completely wrong. 78 cents to my cost basis. That put my risk back to 8.1%. That's not the goal. That's not what we're looking to do, Jason. That's why we don't sell calls when the stock's falling below the put strike price, for the risk of the rebound puts you in that scenario. We have no chance for profit, maybe a little bit of a less loss than what you have in liquidating the married put right now, but you're tripling, quadrupling the risk that you had to the upside if the stock recovers. If you expect the stock to still keep moving down and moving down, hey, Ernie's done it before. He's done it in the Fusion portfolio, sold calls below the put strike price. You just have to be aware of the risks. These are the risks. This would have been a fail for me if I had done that with Caesar. You can see that. Goal I should have mentioned, and we'll probably put up for Fusion subscribers on a management technique that coulda, shoulda, woulda been done, is that income method number 9 after that earnings collapse, after that earning fall. And we saw the MACD bottoming out and starting the crossover. That was the time to roll down the put. And that was the time then we've reduced the cost basis on the entire position down to the $28, $29, maybe even $27 range. And we could have probably a 27 put and be selling 27 calls right now and be at break even with the stock still down 6, 7%. That's what's in the blueprint. You know, it's not a cure-all. What I mean by that is it is a bullish strategy. Don't get me wrong. But the income methods discussed with fluctuations in the market help you manage it. But mismanagement of the income method, selling the call too far below the call strike price or put strike price, selling the call too soon, that's what can get you into trouble. Another thing I included, of course, in that email reply to Jason, we go to Power Options here. I'm going to search on our YouTube channel. And I think I'm just going to type the phrase selling a call below. I'm not sure. I think this was it. There it is. This is from June 2024. There's a 3-part series, married put mini-series. Why not sell a call or spread, one of the riskless spread trades, below the put strike price? Part 1, Part 2, and Part 3. And this is Part 1 here. But if you just do that search for married put mini-series, that's probably a better one. Do that search there for married put mini-series. You'll see Part 1, Part 2, and Part 3. And I included that in by email response to Jason.